Hi, and welcome to the CMC Markets look ahead to the week beginning Monday, the 10th of July, with me, David Madden. Now, before we actually get into details of the announcements that come out next week, let's just have a quick recap of some of the major news events that took place in the week just gone. The Federal Reserve minutes, which were released on Wednesday, were by far the most important announcement of the week we just had. It's very clear that the Federal Reserve want to continue with their tightening of the monetary policy, and in the June meeting the interest rate was raised by 0.25%, the second rate hike of 2017. But when you look through the finer details of the statement, it would appear that the Federal Reserve feel that by keeping rates too low for too long, they would actually end up doing damage to the economy, whereby if interest rates remain rock bottom for too long, you could see a scenario whereby the economy picks up suddenly, and then the Federal Reserve will have to play catch up and have quite a quick succession of rate hikes, which could be detrimental to the economy. So the rate hike we saw in June, it seemed to me more like a scenario whereby the Fed had to raise rates rather than they really wanted to raise rates. It's also worth pointing out that the financial markets had very much priced in a rate hike in June, and should the Fed not have delivered, that would send out quite a negative message to the markets and traders alike. Looking at the state of the US economy, the Federal Reserve are quite happy with the state of affairs in the United States. They don't seem to be that bothered about the relatively weak inflation rate in the US, although some members of the Federal Reserve are concerned that a monetary tightening policy will not go down well when the inflation rate is quite weak. On top of that, the Federal Reserve are keen to actually begin reducing the size of the number of assets on their balance sheet at some point in 2017. But once again, the Fed are divided over when that should start. Some members believe it should start in a couple of months' time. Other members believe it should be more towards the end of 2017. In relation to asset prices, the Federal Reserve talked about the high stock market valuations and the surge in the U.S. equity markets. They put that down to a higher risk tolerance by investors, which conveniently gets them out of the loop, considering that interest rates have been very, very cheap for a very long period of time. And some would say that the low interest rate environment created by the Fed has also fueled this upward move in U.S. equities. Now, looking ahead to the week ahead, beginning Monday, the 10th of June. On Monday, we have Chinese CPI numbers out. That's obviously going to be quite an important announcement, seeing as it's the second largest economy in the world. You have mining companies which will be related to that, will react to the price movements in either direction. I will also see some retail companies here and in the US could be sensitive to the CPI numbers from China. On Wednesday, we have the unemployment rate and wage growth numbers from the UK. Bearing in mind, unemployment is relatively low in the UK, but so is wage growth. And we have a scenario whereby wage growth isn't particularly impressive and inflation keeps moving higher. The average British consumer becomes more squeezed. On Thursday, we have the interest rate decision from the Bank of Canada, where they're widely believed to have their first rate hike since 2010. And on Friday, we have CPI numbers out from the United States. Now, looking at some of the actual markets and how they may or may not react to the announcements up and coming. If we take a look at the FTSE 100, we can see that the FTSE has been selling off for the last number of weeks. And it actually is worth pointing out that this video is recorded on Thursday, the 6th of July at 11:30. So some of the prices I mentioned may be out of date next week, but nonetheless, we'll discuss what's going on in a number of the charts. As we can see here, the FTSE 100 has been declining since the all-time high in late May. And last week, it dropped below the support level at 7,376. And this week, it's made several attempts to try and get it back above that level, which it has failed to do so. While the FTSE remains south of 7,376, the outlook is going to remain negative. We're not too far away from the support at 7,300 currently, and should we move below that, the next level to watch out for to the downside is going to be 7,200. Should we retake 7,376, the next level to watch to the upside in terms of resistance is going to be 7,482. Turning our attention now to the pound versus the US dollar. We've had a bit of a move lower recently, but broadly speaking, the pound has been gaining ground versus the US dollar over the last number of months. The pound is currently receiving support from the 50-day moving average at 128.76. And should we remain above this level, the next level to watch out for to the upside will be the big number, the 130 level, and then north of that again, the resistance at 130.47 will come into play. But should we see a move below the 50-day moving average at 128.76, the next level to watch out for to the downside will be 128 the figure, and also 127.16. As we mentioned, we have the interest rate decision from the Bank of Canada coming up. So let's turn our attention now to the American dollar versus the US dollar. And the dollar versus the Canadian dollar has been very much heading south over the last number of trading. Oh, that is the wrong chart. I apologize. That is the US dollar versus the Australian dollar. This now is the chart of the US dollar versus the Canadian dollar. As I was just saying, the dollar has been losing a lot of ground versus against the Canadian dollar since May. It's to do with a number of factors, largely being that the financial markets aren't entirely convinced the Federal Reserve are as hawkish as they've been letting on. Also, we've seen a lot of volatility in the actual oil market in recent weeks. That's obviously going to be playing in a factor for the Canadian dollar itself. We're currently trading sub 130 on the dollar versus the Canadian dollar. So while we remain south of the 130 level, the outlook is going to remain negative for the dollar CAD, and the initial downside target is going to be 128.20, and then below that we'll be looking towards the August 2016 low in around the region of the, I believe it is the 127.64 area. Should we retake the 130 level on the dollar versus the Canadian dollar, the next level of resistance to watch out for is going to be the 130.55, and then beyond that again, it will be the 132 level. As I mentioned, we have some CPI numbers from the US coming out on Friday, and what to watch out for on that. One of the big markets that is going to be very sensitive to that, of course, is going to be gold, because gold traditionally had an inverse relationship with the interest rates in the United States. Now, this is the price action we've seen in gold over the last six or 7 months. It's been, broadly speaking, in an upward trend, creating higher highs and higher lows. Although we did see quite a large sell-off beginning in June, and we're now seeing what could be the turnaround of that sell-off. Gold was heading south on the anticipation that the Federal Reserve would raise rates in the June meeting, which they did, and it's been pushing lower ever since they have moved rates. They've even broke through the trend line here, which connects the low of the December 2016 low with the low of May. So it's broken through that support trend line, but at the same time, as gold is moving south, it stopped short of the May low, which comes into play at 12.15. We're currently trading at 12.24 on gold, and we do appear to be at least stabilizing. The negative momentum in gold is declining ever so slightly, but we can't really be confident until we actually see that swing back into positive territory. For the time being, while gold remains below the 200-day moving average at 12.33, the outlook for gold will be negative, and the initial downside target is going to be 12.15 and then 1200 itself. But should we retake the 200-day moving average at 12.33, the next levels to watch out for to the upside are going to be the 1250 region, where there's a convergence of the 50-day moving average and the 100-day moving average, and a move north of 1250 will then bring the resistance at 1280 into play. So that's basically it for the week ahead. Thank you very much for listening. I've been Dave Madden from CMC Markets. Have a good week trading and best of luck.